Howdy, folks. It's Adam from Century Concepts, back again with another thrilling adventure into the world of tax regulations. Today, we're going to be diving deep into something that rivals the mystery of the Bermuda Triangle. That's right, we're talking about aggregation and controlled groups. Now, I know what you're thinking. Wow, Adam, can you make this topic any more exhilarating? Well, buckle up, folks, because we're about to embark on a wild ride as we explore the ins and outs of aggregation. In this video, I'm going to outline various situations in which aggregation is necessary. And in the grand scheme of things, most employers usually do not need to have a solid grasp of the regulations concerning both aggregation and controlled groups. I imagine that perhaps the majority of people clicking on this video are doing so as a result of the employee retention tax credit. It's a recent example of something which, in some cases, requires having a comfortable understanding of the regulations concerning aggregation and controlled groups. For this video, I'm also obviously going to be detailing what aggregation is, what controlled groups are, and explaining the criteria concerning the various classifications of such. So, grab your popcorn, put on your thinking cap, and join me as we navigate the twists and turns of IRS regulations. Let the excitement begin. Jumping straight into the action, the first question is, what's aggregation? Well, defining it is the easy part. There really isn't much to it in the eyes of the IRS. Aggregation refers to the action of combining or grouping certain financial data, activities, or entities for tax reporting and compliance purposes. So usually aggregation involves either the combination of gross receipts across multiple different businesses, or maybe even things such as employee count across multiple different businesses. Aggregation is often required when businesses are connected through ownership structures, such as controlled groups, or when specific tax provisions just mandate the combination of information across multiple entities or activities. So there are actually instances where a family member's ownership stake in a business can have ramifications of its own for individuals in certain situations, thus necessitating the need for aggregation. And these specifics are covered in the family attribution rules. And while it doesn't apply to all IRS tax credits and provisions and programs and whatnot, it's still important to know and understand. And I'm going to be covering that more in depth later on in the video at the end. So, the IRS aggregation rules are relevant for multiple tax provisions and credits. So, here are some common scenarios where aggregation may be required. There's, of course, the employee retention tax credit, the most recent example. Controlled groups must aggregate their gross receipts, their employee count and wages to determine eligibility for the ERTC and for calculating the credit amount. However, there are numerous other situations which also necessitate aggregation. Under the Affordable Care Act, more so the employer shared responsibility provisions of the ACA, controlled groups must aggregate their employee count to determine if they are considered an applicable large employer, also known as an ALE. ALEs must either offer minimum essential coverage that is affordable and that provides minimum value to their full-time employees, or instead make a employer shared responsibility payment to the IRS. Controlled groups must aggregate their employees when testing for non-discrimination compliance and qualified retirement plans, such as 401k plans, to ensure that the benefits provided do not disproportionately favor highly compensated employees. To satisfy the IRC Section 410B minimum coverage requirement each year, 401k plans frequently need to provide benefits to the workers of every controlled group member. Failing a coverage test might result from admitting an employee within said controlled group. And when a violation persists for years, of course, the IRS may impose severe penalties, including plan disqualification. That sounds scary. Unlike some tax provisions where aggregation is mandatory, the aggregation rules for the qualified business income deduction, also known as QBI, are optional. The QBI deduction allows eligible taxpayers to deduct up to 20% of their qualified business income from pass-through entities such as sole proprietorships, partnerships, S corporations, and some trusts and estates. Taxpayers with multiple qualifying businesses can choose to aggregate their businesses if they meet specific criteria, potentially maximizing their QBI deduction. One such stipulation is that businesses have to actually be connected or related to each other in some sort of fashion, whether it be that their supply chains are interdependent, they produce similar products with each other, or they share personnel or maybe resources. Based on certain criteria, some business owners may consider aggregation when applying net operating loss, also known as NOL, carried forwards to offset taxable income across different tax years. And the last example that I can probably think of to mention is going to be the research and development R&D tax credit. These tax credits are designed to encourage businesses to invest in innovation and research activities by providing a tax incentive based on their qualified research expenses. Controlled groups and businesses under common control must aggregate their qualified research expenses, QREs, across all entities within the group. They're also required to aggregate their gross receipts, I believe. My understanding and knowledge certainly isn't vast. I learn something new every day, but I'm sure that there are many other programs and credits which also necessitate aggregation. But the aforementioned examples are some of the most relevant. Now, we're finally moving on to the actual meat and potatoes. There is a term that's been tossed around quite a lot throughout this video already, that being controlled groups. Now, if you're scratching your head, wondering what that is, don't worry. In its simplest definition, a controlled group is composed of trade or businesses that are connected through common ownership. So the phrase common control is also used to describe the relationship between these various trades or businesses. Now, it's important to note that controlled groups can be made up of trades or businesses that aren't even incorporated. The term trade or business could be something as simple as passive income generated by real estate activities. So oftentimes in the past, I've had to include clients' real estate activities within their controlled groups for aggregation purposes. So definitely keep that in mind. Anyways, how does someone determine if they belong in a controlled group? Well, that, my friend, is the fun part, and it can actually get pretty tricky at times. There are multiple different kinds of controlled groups. We're going to first take a look at what's known as a parent-subsidiary controlled group. Now, that's a mouthful. A parent-subsidiary controlled group occurs when one or more businesses are connected through a common parent corporation. The criteria for this type of controlled group are that, one, the parent corporation must own at least 80% of the total combined voting power or value of stock of at least one subsidiary, and that each subsidiary must have at least 80% of its voting power or value owned by one or more corporations in the group. And this may include the parent corporation or other subsidiaries. Now, I'm going to illustrate an example of the parent-subsidiary rules in action. So we have Big Tech Corp. They're a large technology company that specializes in developing innovative software solutions. The company has experienced significant growth and decides to expand its product offerings by acquiring other businesses in related sectors. Soft Mobile Incorporated is a mobile app development company that has created several popular applications in the market. Big Tech Corp identifies Soft Mobile as a strategic acquisition target and purchases 85% of the total combined voting power of all classes of Soft Mobile's stock. With this ownership stake, Big Tech Corp now effectively controls Soft Mobile Incorporated. Cloud Secure LLC is a cloud security service provider that complements Big Tech Corp's existing software solutions. Big Tech Corp acquires 90% of the total value of shares of all classes of Cloud Secure stock, thus establishing control over Cloud Secure LLC. Finally, the grand finale, Big Tech decides to also allocate a portion of their capital towards purchasing 60% of the total value of shares of another company, Bold Bytes LLC, a business that specializes in database management. Now, unfortunately, since Big Tech possesses less than 80% of the stock for said company, they will not be included within the parent-subsidiary controlled group. With the acquisitions of Soft Mobile Incorporated and Cloud Secure LLC, Big Tech now forms a parent-subsidiary controlled group. And in this group, Big Tech Corp, the parent corporation, owns at least 80% of the total combined voting power or value of all classes of stock for both Soft Mobile Inc. and Cloud Secure LLC. In addition to this, both subsidiaries are connected through their common parent corporation, Big Tech. Moving forward, next up on our list to discuss are brother-sister controlled groups. A brother-sister controlled group exists when 2 or more businesses are owned by a group of 5 or fewer individuals, corporations, states, or trusts that not only have common control interest in these businesses, but also have what's called effective control of said businesses. So the criteria for this type of controlled group are that 1, the same 5 or fewer persons must collectively own in stock at least 80% of the total combined voting power or 80% of the total value for each business, and that they possess effective control greater than 50% across the various corporations, but only to the extent that such stock ownership is identical with respect to such corporation. Now, effective control can be a bit tricky to understand, especially that last part. I don't want to get too lazy, but for this particular instance, I want to use an example that's been provided by the IRS themselves. This example scenario is taken from the IRS Controlled and Affiliated Service Groups packet. I include a link to it in the description in case you want to check it out for yourself. It covers a lot of the same material from this video, so definitely give that a look. So we've got Adams Corp and Bell Corp, and they're owned by 4 different shareholders in the following percentages. So shareholder A owns 80% of Adams Corp and 20% of Bell Corp. Shareholder B owns 10% of Adams Corp and 50% of Bell Corp. Shareholder C owns 5% of Adams Corporation and 15% of Bell Corporation. Shareholder D also owns 5% of Adams Corp and 15% Bell Corp. That was a mouthful. In order to pass the first test, the same 5 or fewer common owners must possess more than 80% of stock across all entities within the controlled group. You can see that all 4 shareholders together own over 80% of the stock. As a result, the first test is met. Now, in order to meet the second part of the test, the same 5 or fewer common owners must hold more than 50% of the stock for each corporation, taking into account the stock ownership of each person only to the extent that such stock ownership is identical with respect to each such corporation. So the way that this is worded is a bit tricky to understand. Basically, they're saying that for determining effective control, a shareholder's stock ownership percentage must be identical to each such corporation. This is determined by basically looking at the shareholder's lowest value of stock ownership percentage across the various corporations, and then basically adding them together. So in this particular instance, it would look like this. Shareholder A's identical ownership percentage is 20%, shareholder B's is 10%, C is 5%, and D is also 5%. So in total, that is 40%. Since they do not have effective control over 50%, they failed the second test to qualify as a brother-sister group. There is another example included within this packet. You can see it here. So you can try to group any 5 of these individual corporations together, you'll see that they definitely pass the identical stock ownership test. They have effective control. That is not an issue. The issue is that it's impossible to create a group of 5 or less corporations that own more than 80% of each corporation's stock. As a result, they will not be considered a brother-sister group. Brother-sister groups are especially common in my line of work personally. I often deal with small-time business owners that have multiple LLCs in which they're the sole shareholder. So they possess 100% ownership across all the different businesses. And as a result, these businesses typically get grouped together within the same brother-sister group. Finally, the last type of controlled group is a combined group. A combined group is a bit more of a complex structure that involves elements of both parent-subsidiary and brother-sister controlled groups. The criteria for a combined group is that each organization is a member of either a parent-subsidiary or brother-sister group, and that at least one corporation is the common parent within a parent-subsidiary controlled group, while also being a member of a brother-sister group. Again, that sounds a bit confusing. So to save myself effort and pain, we're going to take another look at an example that the IRS thankfully provides us within the same packet from earlier. So A is an individual who owns 80% in York Partnership and 90% in Sharp Corporation. Now, York Partnership, which A owns 80% of, they have a stake of 85% in a company called Trip Corporation. Now, as a result, York Partnership, Sharp Corporation, and Trip Corporation are all members of the same combined group together because they are each members of either a parent-subsidiary group or a brother-sister group. So you'll see that York, which owns 85% of Trip Corporation, is the common parent within their parent-subsidiary group relationship. Then, of course, York is a member of a brother-sister group alongside Sharp due to the fact that individual A owns 90% of Sharp Corporation. So, wow. Well, anyways, I can't believe that we've covered every type of controlled group. I was really expecting this to take longer. So, the last thing that I want us to cover in this video are the attribution rules, specifically the family attribution rules. These rules are a set of IRS regulations that determine the constructive ownership of a business interest based on an individual's relationship with family members who own a direct interest in the business. You know, I love them or hate them. In certain instances, you do have to take the family attribution rules into account. They can get very complex at times. There exists different criteria for determining family attribution depending on the circumstance. There are rules established in IRC section 318 and different rules mentioned in section 1563. We're going to be looking at section 1563's rules as these specifically govern controlled groups. As a heads up, these rules only apply to brother-sister controlled groups and not to parent-subsidiary controlled groups. Here's a lovely chart provided to us courtesy of the IRS. As part of the section 1563 family attribution rules, an individual is considered to own the interest owned directly or indirectly by their spouse. There are some exceptions to this. If all 3 conditions below are met, then the individual will not own the aforementioned interest of their spouse. 1, the individual does not own directly any stock within the corporation. 2, the individual is not an employee or director or does not participate in the management of the corporation. 3, not more than 50% of such corporations' gross incomes for such taxable year have been derived from passive investments. As shown in the chart, ownership interest of a minor child, someone below the age of 21, are attributed to a parent. So if a minor child owns 100% of a company, perhaps they had inherited said company from a relative, then their parents would also indirectly own 100% of the same company. So inversely, the same can be said about the ownership interests of a parent, which is attributed fully to any minor child under the age of 21. If the child is over the age of 21, then the parent's ownership interests are also attributed to them, but only if the adult child owns greater than 50% of said business. Now, once again, the inverse of this is also true. The ownership interests of an adult child are attributed to the child's parent only if the parent owns greater than 50% of said business. Now, grandparents. You don't see this one too often. I've definitely never seen this one before personally, but a grandparent's ownership interests are attributed to either a minor or adult child if said child owns greater than 50% of that business. Inversely, a minor or adult child's ownership interests are attributed to their grandparent if the grandparent owns greater than 50% of that business. Finally, to wrap things up, the ownership interests of siblings are attributed to, drumroll please, nobody. Now, let's dive into some juicy example scenarios. In our first example, we have John and Jane, who are happily married and together own a retail business. John owns 70% of the total stock, while Jane owns the remaining 30%. Now, due to the spouse attribution rules, John is considered to own Jane's 30% interest in addition to his 70% interest. Likewise, Jane is considered to own John's 70% interest along with her 30% interest. As a result, both John and Jane are treated as owning 100% of the business for tax purposes. In our second example, Samantha owns 100% of a small bakery, Cake Heaven Incorporated. Her son, Aiden, who is 19 years old, decides to start a catering business, Food Delight LLC. Since Aiden is under 21 years old, Samantha is considered to own Aiden's interest in Food Delight LLC due to parent-child attribution rules. Similarly, Aiden is considered to own Samantha's interest, in Cake Heaven Incorporated. Our third example relates to grandparent-grandchild attribution. How interesting. George owns 60% of a construction company, BuildPro Corporation. His granddaughter, Lily, who is 18 years old, owns 40% of a real estate agency, Homefinder LLC. Due to the grandparent-grandchild attribution rules, George is considered to own Lily's 40% interest in Homefinder LLC, and Lily is considered to own George's 60% interest in BuildPro Corporation. Before I wrap this video up, I want to take a look at the IRS packet shown earlier. It's a really good example scenario about family attribution that I want us to look at. So take a look at this beautiful illustration that depicts the ownership that a father and his two sons possess in a partnership. You have son A, age 20, who possesses 30% of this partnership's profit interests. The dad's stake in this partnership is 40%, and son B, age 30, possesses 20% of this partnership. The remaining 10% of interest is owned by an unrelated person. Let's take a look at dad and his ownership. He himself directly owns 40% of this partnership, and of course he is considered to own the minor son A's 30% interest. Altogether, dad's ownership as it stands is 70%. Now this is something that I didn't know up until making this video, but son B, his ownership interest actually gets attributed to his dad, despite son B being older than 21. This is because after taking into account minor son A's 30% interest, which is attributed to the dad, said dad now has effective control over the partnership. Due to him having effective control, apparently the non-minor son B's ownership will become attributed to the dad. In total, the dad owns a total of 90% of the profit interests in XYZ partnership. Who would have guessed? Now, son A, age 20, directly owns 30%. Since he's a minor, he is also attributed the profit interest of his father, that being 40%. Now, son A is not considered to own the 20% that son B possesses, which is attributed to the father as discussed previously. Son A's total profit interest amounts to 70%. Finally, son B, age 30, directly owns 20% of the profit interests within this partnership. He is not considered to own the 40% interest of XYZ partnership of his father. This is due to him not being a minor. Now, if son B's interest within the partnership would have been more than 50%, then his father's interest would have been attributed to him. Well, that's all, folks. I'm surprised that this video did not turn out to be longer. Aggregation, controlled groups, and family attribution, all words that I don't ever want to hear again. Anyways, I'm very grateful that y'all decided to check this video out. I'm Adam from centuryconcepts.com. There's no doubt that aggregation can prove to be a tricky beast. If for whatever reason you still need assistance, then feel free to reach out to me and I'll be happy to help. So have a great day. See you next time.